Hey, welcome back. I'm Jack Gately from Jack Gately Real Estate and the Online Real Estate Academy. Let's take a look at today's real estate news. If you've been watching us for any period of time, you've been noticing that I've been saying, hey, I'm fairly bullish on the economy, even though interest rates are going up. And even though the strategy of the Fed is basically to cause a recession, right? That's their strategy. Raise rates to cool the economy and kill off inflation. That is the strategy. But that really hasn't worked yet. But maybe we're actually starting to see the beginning of that. I made a video, I think it was last week, that I thought we should keep a weather eye on the economy. And the number one thing that I was concerned about is the jobs market. And over the last day, or this morning, I should say, and yesterday, we've gotten some concerning jobs numbers. Some concerning job numbers that we haven't really seen in the U.S. economy for quite some time. Let's take a look at this morning's headline from CNBC. See, we bring it up here. U.S. job growth slowed sharply. See if we can scroll up here. No, we're going to have to do it this way. U.S. job growth slowed sharply to 177,000. Come on, computer. In August, ADP expectations show. Little glitch there. Sorry about that. So the ADP job numbers are out, effectively, is what I'm saying. And they're not good. They're not good. This is published Wednesday this morning at 8:15. Job creation in the United States slowed more than expected in August, according to ADP, the giant payroll processing company. You know ADP. A sign that surprisingly resilient U.S. economy might be starting to ease under pressure from higher interest rates. The firm reported Wednesday that private employers added 177,000 jobs in August, well below the revised total of 371 added in July. Economists surveyed by Dow Jones were expecting 200,000 jobs for August. So they missed that, not by a giant amount, but they missed that. ADP also reported that pay growth has slowed for workers who changed jobs and those who stayed in their current positions. This month's numbers are consistent with the job pace creation before the pandemic. Well, that's a stretch, I think. After 2 years of exceptional gains tied to the recovery, we're moving toward more sustainable growth in pay and employment. This is a fairly optimistic statement. As the economic effects of the pandemic recede, the weaker than expected report comes as investors and economists are split on whether inflation in the United States can continue to trend down to 2%. We're really not trending that close to 2%. If you look at core, we're still at 4.7. And I don't know if you've also noticed, but there's a huge effort amongst Paul Krugman and the Boston Globe, the New York Times, all that crowd to actually up the target to 3%. I think there's actually an unwritten, consensus that they're never going to get it to 2%. They're saying 2% because it sounds good, but I think the Fed will be okay with somewhere in the 2 range. And there's a big press on the kind of the left side of the economic spectrum to say that 3 is going to be a reasonable target. And why would that be? Because at 3, that means we have inflation for higher or longer. And of course, inflation is a tax that you don't have to vote on. So it's pretty convenient that way for some people. North of Richmond. The Federal Reserve hiked rates to the highest in 22 years in July. Fed Chair Powell signaled last week that the central bank was prepared to raise rates further if need be. Here's the money quote here. The ADP report has traditionally been a signal of what the Department of Labor monthly jobs report will show. However, the firm did change its methodology last year, which makes its predictive tendencies less clear. I'm thinking that the Labor Department changes its methodology like month to month, depending upon the politics. The labor report is due out on Friday before Labor Day weekend. So looking at that, there was some significant concern about the JOLTS report, which came out, yesterday, Tuesday. And effectively what we've been looking with the JOLTS report and a lot of the Bureau of Labor Statistics numbers, and this is why I've been concerned about it for quite some time, is they report a fairly positive jobs number as the headline number, but then there's been a trend, a significant trend, in other words, like every single month, of how do I want to say that? Of revising the prior month's number. So it comes out and it looks great, but then when no one's looking, a month later, they revise it down to the real number. And Zero Hedge covered this yesterday at length. For months, we've been warning at a time when the U.S. economy is careening into a hard landing recession. The manipulated, seasonally adjusted, and politically gold-seeked job openings data as part of the Department of Labor JOLTS report is sheer rubbish, according to Zero Hedge. And today's BLS finally got the memo, with the consensus expecting only a modest drop in the July openings from 9.5 to 9.6 to 9.5. BLS reported instead a doozy. In July, there were only 8.8 million job openings, the first sub 9 million print since March 2021, and the third biggest miss on record. In other words, even the government can't hide the fact that the labor market appears to be slowing down. And then the government really can't hide this anymore. It's really, really hard to hide this anymore. Let's bring up the chart. Worse, the BLS not dramatically had the BLS not dramatically slashed the May number from 9.6 to a laughable 9.1, the drop would have been almost 800,000 job openings. And yes, today's downward revision. In other words, they keep on revising the numbers down. All of the monthly jobs data was revised lower. And now the housing data has also been revised lower. Drum roll, please. Every payroll number, I think this is the kicker here. Every payroll number, thank you, Zero Hedge, for providing this tweet, in 2023 has been revised lower to manipulate perception and markets. I mean, just look at this number. The last two columns on July, they haven't been revised lower yet, but that will probably come on Friday. Every other payroll number, January, February, March, April, May, June, all of them, as you can see from the little red arrows on the chart, bring that up even further for you, have been revised lower every single month. And probably July's numbers will probably also be revised lower. I mean, that has been the trend. So, what does this mean for the economy at whole? By the way, this Zero Hedge, which we'll probably link in the, there's a lot more data in here. We'll link that in the description. What does this mean for the economy as a whole? You know, that's a very interesting question. What does this mean for an economy as a whole? What does this mean for the housing and real estate market? How are the markets going to react? Well, what we've seen over with our friends at the mortgage rates is we've seen mortgage rates falter over the last, say, 5 or 6 days. That's been fairly clear. And we hit about 7.5% for a 30-year fixed last week. And if you locked in on your mortgage last week, you lost. Sadly, sorry to chuckle, because now rates are down to like 1.1, 1.2. That's a savings, of course. And it's starting to have people ask, like Mortgage News Daily here, is the top in for mortgage rates? And they go right to the JOLTS report, which we discovered. No one had much to say or think about the JOLTS report over the past few decades, but it has risen to an increasingly prominent market-moving role in 2023. Today was the latest example of a big miss, resulted in a big bond market win. Taken together, last Wednesday's PMI-driven gains, 10-year yields are 25 basis points off the last week's highs. That's the kind of reversal that makes people start thinking about longer-term tops. So was it a top? And the answer depends on the extent to which you can accept the Fed's data-dependent thesis, or the basis upon whether or not you think the government's going to stop spending. Because most of these recent rate hikes are based on government spending, right? That's what they're based upon. They're based upon additional government debt. Do you really think that the Democrats or the Republicans are going to rein in government spending in any meaningful way, or even at all? I think the answer is obviously no. It's a resounding no. Whether the spending is domestic or foreign, Ukraine, they're going to continue to spend like drunken sailors, like I spent when, back in the day. Oh, let's not get into it. But they're going to spend. I mean, look at the slip in mortgages. It's not like the market is not paying attention to these job numbers. I just don't think they're going to be able to slow the economy down that much using just the Fed. That's just not going to happen. We will see the Fed impact the economy. By raising interest rates, you slow down the economy. But that's only one of the two governmental levers that you have to work the economy. The other one is government spending. And the more you spend, the more you eat into the private productivity of Americans and of the nation. And so, if you pull back on government spending, you put more money into the private economy, which produces for the American people. That's a pretty simple equation. But lower, higher for longer. Eventually, when jobs start to falter, you are going to see some dip in mortgage rates, and that's what we're talking about here. At the height last week, 7.9%. Thank you, Lance Lambert. Basically 7.5% last week, and today, 7.12. Yeah. And I think we'll see this. I think if we see the job numbers slip again, we might get below 7 fairly soon. I like this tweet because it showed that, was it this tweet? No, I don't think it was that way. It showed that, where did it go? It's not here. But it showed that the low rate for mortgages this year was just under 6, 5.9-ish. And now, it went up basically a 1.5 within this calendar year, within 2023. That is a big jump. So just to rephrase what I said just a moment ago, is these Fed actions are going to have some impact upon the economy, for sure. The strategy is to slow down the economy. The strategy is to cause a recession. That's the plan. Right? That is the plan. And it will have some effect. Usually it takes, the conventional wisdom, for whatever that's worth, like a year and a half, 18 months for that to kind of go into effect. We would now just be in the very beginning of that recession based upon the Fed rate hikes. So it's predictable, if the conventional wisdom is right, that these job numbers would get worse as these months go along into early next year. On the flip side, the other factor is, and as you see the job numbers get worse, you would effectively see people need to sell, and probably mortgage rates will go down as the economy cools. The other thing working against that is government spending, which is not going to decrease, and that actually make this recession string out for longer and make rates higher for longer. So we'll have to see. I'm a big fan of ripping off the Band-Aid. Having that recession be a hard landing. Because once you have a hard landing, you clear out that inefficiency as quickly as possible. It's painful, but you clear out that inefficiency as quickly as possible, and then you can bounce back. That's the best for the economy. But that's not best for the ruling class. That's not best for the politicians. The politicians, it's best to drag it out for longer. Yeah, that's what's best for them.